Have you seen in the recent times that the share price of companies with high debt have crashed like anything? Debt is not only bad for individuals but also for companies. Agreed that leverage is important for the business to expand and grow, but too much of leverage could become a big problem during tough times. Hence, before investing in the stock of a company, it is important to check if the company has debt more than what it can afford. If a company has huge debt, then major portion of its profits may be eaten away by the interest payments. Also, when there is a recession or a bad time for the market or the company, then the asset value and the income of the company may reduce. As these assets are given as collateral for the loans, the company could come under pressure from lenders. In case if the debt becomes unmanageable using the current assets, then the company may even go bankrupt and share value will come down to zero. Hence, identifying companies with zero debt is very important when you invest your money for long term. It doesn't mean that zero debt companies show high growth, but they show stability during the tough times and your capital is protected. This video will show you how to identify the debt-free companies yourself easily within 5 minutes. Welcome to Save and Invest Smartly. So how do we check if the company has debt or not? A company that is listed in the stock market makes its balance sheet available to public periodically. This balance sheet can be accessed from popular financial websites like Moneycontrol or Economic Times. We can find out the debt of a company by going through the balance sheet. For example, let us take a popular large cap FMCG stock, Hindustan Unilever Limited, and check if it has debt or not. From your browser, visit moneycontrol.com. In the search bar, enter the name of the company and select the one that we want. This will take you to the next page showing complete details of the stock. Now click on Financials. You will find sub-menu under Financials. Select Balance Sheet from the sub-menu. In the balance sheet, you will have two sections called Non-Current Liabilities and Current Liabilities. From the non-current liabilities section, we need to pick the value for long-term borrowings, and from the current liabilities section, pick the value for short-term borrowings. When you add these two values, you will get the total debt of the company. In case of HUL, both the long-term borrowings and short-term borrowings are zero, and hence the total debt is zero. We can call this a debt-free company. Why are we taking the long-term and short-term borrowings from the liabilities section? Shouldn't we consider total liabilities? No, because liabilities and debt are not the same. They are different. Liability is a broader term giving the details of anything that you owed to others. Debt is a specific term indicating something that you have borrowed. All debt is a liability, but all liabilities are not debt. For example, a company may have to pay the monthly bills, which may be a liability, but this is not a debt. Hence, please be clear that when we want to check the total debt of a company, consider the values of only the long-term and short-term borrowings. Alright, we now know how to check the debt of the company to find out if it is debt-free or not. But how can I get the list of all companies that are debt-free? You can easily get this using screener.in. From your browser, visit screener.in. You may log into this using your Gmail ID. Once you log in, click on Screens from the menu. You will get an option, New Stock Screen, to create a new screener for yourself. On clicking this, you will get a query window where you will be able to write the query to filter for the stocks as per your criteria. Don't worry, writing query here is very simple. Let's say I want to filter for all the debt-free companies in the Indian stock market. Give the condition as debt equal to 0 and click on Run this query. You will be able to see the list of all companies where debt equal to 0. But there are 501 companies in this list, showing even the small cap companies. What if you want to restrict to only the large cap companies to be more safe? Large cap companies are those that have market capitalization of more than 20,000 crores. Let's add that criteria as well. Make sure you separate the filter conditions using the AND operator. Now click on Run this query. You will now see the list of all large cap debt-free companies. There are total 13 companies. But wait, we have heard many times that ITC is a debt-free company. But why is it not in this list? Let us check the balance sheet of ITC in Money Control. Search for ITC in the search bar. Go to the financials and then balance sheet. We see that the long-term borrowing is 7.89 crores and short-term borrowing is 0. So here the total debt is 7.89 crores. That's the reason this has not come in our list. But this debt is a negligible amount when compared to the size of the company, right? Also, it is natural that most of the companies will have a small amount of negligible debt. So if we don't want to miss these kind of companies in our filter, then can we say debt less than 50 crores instead of debt equal to 0? But the size of the companies are different and this kind of absolute condition may not work well. We need something relative. This is the reason analysts use the debt to equity ratio instead of debt value to identify the debt-free or low debt companies. What is debt to equity ratio? Debt to equity ratio is simply the ratio of total debt to total shareholders' equity. In this case, the total debt as seen earlier is the sum of long-term borrowing and short-term borrowing. The total shareholders' equity is how much the shareholders of the company have invested in the business, which can be arrived easily by deducting total liabilities from total assets of the company. You can find the value of shareholders' equity under the first section, shareholders' funds, in the balance sheet. In case of ITC, this value is 57,949.79 crores. Let us cross-check this value. The total asset is 69,797.92 crores and total liabilities is sum of non-current and current liabilities, which is 11,848.13 crores. Now subtracting this from the total assets, we get 57,949.79 crores. This is the same value shown as shareholders' funds. Now let us calculate the debt to equity ratio by dividing the total debt by total shareholders' equity. In case of ITC, we get approximately 0. That's the reason ITC is also a debt-free company. You don't have to find out the debt to equity ratio every time by calculating yourselves. You may just go to the sub-menu Ratios under Financials. In the section Profitability Ratios, you'll be able to find the debt to equity ratio. Let us now modify our query in the screener to get the list of large cap companies with debt to equity ratio equal to 0. Just replace debt with debt to equity and then click on Run this query. This list now has 17 companies and it includes ITC as well. Debt-free companies will add good stability to your investment portfolio during tough times. Hence, have them as a portion of your portfolio, but don't build your entire portfolio on these companies, as you need high growth companies as well to build your wealth over long term. I'll be posting more videos explaining how to pick high growth companies and build your wealth. If you are new to this channel, please subscribe and hit the bell icon so that you don't miss any of the future videos. Thank you.